Before this summer's credit squeeze, the international financial system enjoyed abundant liquidity. Historically low interest rates and a strong economy fueled a housing boom in the US. US home buyers, betting on continued house price appreciation, took out sizable mortgages. Banks and other lenders granted these loans with little regard for the borrowers' credit histories. Meanwhile, Wall Street was buying mortgages of its own in the form of collateralized debt obligations, or CDOs. These are pools of mortgages and other debt and are structured to offer savvy investors attractive returns. Rating agencies like Moody's and Standard & Poor's assigned their highest credit rating to some of these CDOs, which encouraged pension funds, hedge funds, and other institutional investors to buy them. But little did these investors know that these CDOs weren't entirely safe. As the housing boom in the US cooled and interest rates rose, individual borrowers found it increasingly difficult to meet their mortgage payments. Many of the people defaulting on their loans were so-called subprime borrowers, people with shaky credit histories and often no jobs or regular income. Rising mortgage defaults undermined the collateral base of the CDOs, sending asset values tumbling. Hedge funds began to find it more difficult to get finance as Wall Street banks, who were themselves feeling the pain of the credit squeeze, became less willing to lend money against mortgage securities. This forced hedge funds to sell all manner of assets, some of which are not linked to mortgages at all. Investors in the commercial paper market then realized that some of the vehicles which have been issuing commercial paper notes may also be holding subprime assets. They panic and stop buying commercial paper. This hurts financial institutions which rely on commercial paper for funding, such as structured investment vehicles, off-balance sheet entities which have been widely created by banks in recent years. Then even the banks stop lending to each other. The crisis of liquidity, sparked by a US housing slump, leads to the near collapse of a UK lender, Northern Rock. The central banks try to stop a money market freeze by pumping funds into the system. This stops the panic from snowballing, but it does not entirely end the sense of paralysis and fear in the funding markets. Back in the US, home buyers are squeezed even further as their mortgages reset from low introductory offers to much higher interest rates. In some cases, borrowers are faced with a significant loss of equity, as falling house prices mean the value of their home is now less than their mortgage repayments. But the really big question now is what impact this will all have on the broader economy. Until now, this has been performing relatively well. But if credit is reduced to companies and consumers, this could hurt the economy going forward.